Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today we're going to be talking about commercial leases. Now, what I find is when people haven't dealt with commercial before or they're very new to commercial, there's quite a lot of intimidation around commercial leases, and that's totally understandable because it's a totally different lease document than you've got in residential. And it's very, very crucial in terms of the value of your building. And if you've listened to this podcast before, if you've invested in commercial, you'll know that a lot of commercial property, the way to add value really is to get as long a lease as possible to the best tenant as possible, paying as high a rent as possible. So the lease document is absolutely crucial in terms of the value of the property. And, that our value, very, very simple valuation, which is rent divided by yield. Then, the yield is called the all risks yield. It's a reflection of all the risks. And if the lease is too short, if it's not kind of a standard lease, lenders like to see standard provisions. They like to see rent reviews. They like to see standard tenant covenants, which we'll go into in a minute. They like to see that the tenant's going to be repairing the property and all kinds of other things. So it's really important to understand a commercial lease, but it's really important also not to be intimidated by it, because you actually can get this skill set pretty quickly. And so if you're shying away from commercial leases, I would just encourage you to dive in. And you don't need to send this to a solicitor to begin with. Now, there is a caveat to that, of course, but just have a read of it. And so if you're looking at a property, even at the early stages, ask for the lease. By the way, you'll be surprised at how few agents actually have the lease. So that's one to test out. It's not great marketing if you've not even read the lease when you've fixed a price. And that'll give you a good idea as to whether the price is a bit of a finger in the air or whether they've actually got some grounds for it. So obviously, we do want solicitors to look at the lease, especially if we're getting serious about a property, and certainly in the due diligence period of your purchase. And definitely if you are creating a new lease to an occupier, it's really, really important to get a solicitor involved. But equally, what you don't want to do is be forking out for a solicitor every time you're looking at a property to buy. So you need this is kind of a muscle you need to grow. You need to develop this skill set. And so I'm going to give you some pointers today as to how you do this. So the first thing really is just dive in, just start reading leases, and you will start to see where the different lease clauses are. The definitions are usually at the front. Every lease is different, of course, but you will see where the lease length is, the user clause, the alienation clause, the repairing clause. And so you will start to see where these things are. Sometimes the rent review clause and the insurance provisions, sometimes they're in schedules to the rear of a lease. Sometimes they're in the bulk of it. So every lease is different, but there are standard lease clauses that go into a lease. And so just kind of dive in, read as many leases as you can. And actually, you will get to the point that I'm at where I can literally skim through a lease and see the major points, because initially when we're looking to stack a deal, what we're trying to do is we're trying to find the key lease clauses, the things that will affect value, things like rent, things like who repairs what, user clauses, alienation clauses, lease length, break clauses, rent reviews, the major lease clauses in that, and of course tenant covenant, because the quality of your tenant is super important for the valuation. So let's dive in and have a little chat about leases and what's included in them and what you need to look out for. So the first thing I would say is that what is a lease? Well, a lease is basically a contract between the person taking the property and occupying it for their business, which is the tenant, and the person who owns the property, who is the freeholder or the landlord. Now, of course, they're not always the freehold. Sometimes you can have like leaseholders or subleases or whatever. So it's the person basically granting the lease who is the landlord. And it's just a business agreement. So, from that point of view, it's nothing to be fearful of. It's incredibly standard. It determines the income, the risk, the financeability, the value, and ultimately the profitability, easy for me to say, of the investment. So what you want to do is you want to really kind of get under the skin of your lease. So I'm going to walk you through the different lease clauses that you need to look at. And then, hopefully you can start to point these out. So simply what the lease will do is tell you how long the tenant's occupying for, how much rent they'll pay, who repairs what, rights and obligations, review mechanisms, and basically what happens if things go wrong, if either party breaches the lease. So, for example, if the tenant doesn't repair like they're meant to, what remedies does the landlord have, and vice versa. So, in residential property, investors focus heavily on bricks and mortar, how the property looks. In commercial, experienced investors focus heavily on the lease, and that's what we're looking at today. So the first thing, when you a lease kind of lands on your desk, so there are various thicknesses, for a small, short tenancy to a local tenant, you might be looking at a minimum of probably 10 pages. Now, you don't want to make your lease too long to those kind of tenants because it can be a bit intimidating, through to 70, 80, 100 pages in some occasions. So don't be surprised if you get a really short lease or get a really long one. The first thing to look at is who's taking the lease. So who's the tenant, who's the landlord? Are there any guarantors, whether they're personal, whether they're external guarantors? So you want to ascertain that and then you want to be doing checks ultimately, maybe not straight away, but you want to be doing checks on that tenant, their covenant. You want to be assessing whether they're good for their money and they're going to be around long enough to be able to pay you rent for the length of the lease. So that's really, really important. Then you want to look at how long the lease is. That's probably the first thing that I would check. After that is how long is that particular lease.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So you want to make sure that you look at the remaining lease terms. So obviously there is a start date for the lease. So there's a date the lease is signed, and then you want to find the start date of the tenancy, which could be different from the date the lease is signed because there might be kind of various factors. There might be time lags. And you want to find how long, when the lease expires. So that'll all be in your lease. And that's really important because it governs certainty and surety of obtaining your income. So, banks like this, because obviously if it's a longer lease, then, and they're granting you a mortgage, they know you're going to be able to pay it, get it covered by the tenant or tenants. Valuers care because obviously the longer a lease is, then the more certain and less risk that income is. And investors care because, the difference between a good investment and a bad investment is sometimes the length of the lease, obviously the tenant covenant, the rent, etc. But, sometimes the length of the lease is what's really, really important. So long leases usually are lower risk, and short leases are on paper higher risk, but can create better opportunities to add value. Because one of the first things you need to do when you're looking at a property that's occupied by a tenant is find out how they're trading. Are they happy there? Do they want to stay? And of course, if they do want to stay and the lease is coming up to an end, then there's a negotiation to be had even before you buy the property. And so you can even add the value before you buy the property. And it's very common to do that. You can do pre-lets for new tenants. You can do lease extensions or lease renewals before you buy the property. Obviously, you need to wait to buy the property to actually get that in place. And valuers and agents will refer to something called the WALT, which is a weighted average unexpired lease term. I have mentioned this in previous episodes. And basically what you do is you look at the different lease lengths across the multi-let property, and then you will weight them by floor area. So for example, if there's one tenant that has 90% of the space that has a lease of 6 months, but there's the other tenant has a lease of 10 years, obviously the WALT will be a lot lower because the occupier that has the bulk of the space has a very short lease. So that's kind of how it works. So a lease with only 2 years remaining means something very different than a lease of 15 years. And you'll find that different tenants will want different lease lengths. Very often, if a tenant's fitting out, spending a lot of money on the property to begin with, very often they will be looking for potentially a longer lease, so that they can write off the cost of their fit out. Of course, sometimes they will ask the landlord to pay for that fit out, and then they'll have a more flexible lease. But more often than not, if they're actually paying for their fit out, something like a restaurant or a gym, or, there's a reason why they have longer leases, and that's because they have to amortize or write off their fit out over a longer period of time. The next thing we look at is the rent. And there'll be a starting rent in your lease, but also you need to get rent review memorandums. What they do is they will be documenting how the rent has increased. Sometimes there'll be a step rent. Sometimes there'll be fixed rent reviews. Sometimes, so there'll be all kinds of mechanisms potentially in that lease, but you want to find out what rent the tenant is currently paying. So if that lease has been going for some time and there's been rent reviews, you'll want to see something called a rent review memorandum. And that basically documents any rent reviews that have happened. And then what you want to do is you want to look at whether, in comparison to the market. So you look at comparables, you look at whether that's too high, whether that's or higher than the market, whether that's lower than the market, or about open market value or ERV, estimated rental value in the market. And of course, each one is different. So if you're over rented, i.e. your passing rent is higher than the market rent, then you know that when there's a lease renewal or a new letting, you will drop down to market rent. So there's an element of risk associated with that. If you're around the market rent, then, the situation will be stable. And if you're under rented, your property's under rented, you know that if there's an upward only rent review, that there's a potential for you to increase that rent, or indeed at lease renewal or new letting, there will be a increase into market rent. So obviously that's an opportunity. And so, you want to really understand this stuff to make sure that you know kind of where your asset management can be. And therefore, there might be something called reversionary opportunities, which is where you could revert to open market rent, i.e. the open market rent or the ERV is higher than your passing rent. And it tells you about future rental growth and asset management potential as well. So that's really important. And of course, then we want to see whether there's any rent reviews. Now, I have done a podcast episode on the recent change in legislation about upward only rent reviews. So have a little listen to that. But a lot of the historic leases that you'll be looking at, they will have rent reviews. They might be index linked, like CPI or RPI linked every year, 3 years, 5 years. They might be open market rent reviews every 5 years, upward only, upwards and downwards. So it's really important that you understand, again, fixed uplifts, open market reviews, index linked, whether they're upward only or upward downwards, because investors don't just buy today's income, they will buy the potential for the future income going forward. So, the beauty of upward only rent reviews is you've got a hedge against inflation. You have growth potential, especially if your passing rent is lower than the market rent. and there's potential to add value. So that's what we're really interested in. Now, when we're thinking about lease term, we also are interested in any break clauses. So break clauses will be within the lease. And now what a valuer will do is, if there's a tenant's break clause, they will only value up until the break clause, because they will always assume that the tenant will break the lease. And so sometimes these break clauses are tenant only, sometimes they're landlord only, and sometimes they're mutual. So what you want to do is absolutely understand that. And also the mechanism. Do they have to give 6 months notice, 12 months notice, 3 months notice? Because obviously the more notice you get, the more you can plan for your asset management. And, so a 10-year lease with a 5-year tenant break isn't, in a valuer's eyes, in the market's eyes, is not a 10-year lease. It's actually a 5-year lease, because there was always the assumption that tenant will go. So unless there's obviously evidence that tenant is going to stay. So there's obviously an impact on value, there's an impact on finance, and there's an impact on risk. Now you can influence this through your asset management. So, when you're speaking to the tenant and they say they want to stay, you could even maybe keep some money in your initial appraisal to maybe pay the tenant to stay. In law, you're not permitted to do that, but anything's possible by mutual negotiation. It might be a win-win. So, for example, if that tenant has, the shop's a bit shabby or the unit's a bit shabby and they might want to refit out, then could you, say, well, look, if you stay a bit longer, I'm happy to kind of front you a bit of money to fit out and to make the property look better. And they might actually bite your hand off for that. So again, there's ways and means, but we need to understand the impact on our asset management. Then we want to understand repairing obligations. So this will often be in the decoration clause. It'll say internal, external, and external. And what we're really interested in is this a full repairing and insuring lease? What that means is that the tenant will lock, stock, and barrel repair and insure the property. So that means your landlord's income is very, very hands off. Or is it internal repairing only, which means that the landlord has a liability for the externals, that potentially they will have to run a service charge if there's multiple units. So full repairing insuring leases are usually better for landlords. And, the tenant has to hand that property back in a condition that they took it, save for fair wear and tear usually. So this means that commercial property obviously can be very, very hands off if you have this type of lease. So it's really important to understand this repairing liability. And when you grant a lease, or when you're looking to buy a property, you want to either get a schedule of condition prepared when you hand the property over to the tenant, or look for a schedule of condition. You'll be amazed at how few landlords actually prepare this. It just makes everything easier. It makes it less confrontational. And, be very careful for hidden liabilities. So if the tenant has carved out any repairing liabilities and put them back on the landlord, then you will need to deduct that from your gross rent. So this stuff is really, really important to understand. And again, it'll affect your finance, it'll affect your risk, it'll also affect your valuation. Then you want to look at alienation. Can the tenant assign or sublet the lease? Assignment is when the tenant transfers the lease lock, stock, and barrel to another tenant. Subletting is when the tenant rents their space to somebody else, but they still kind of keep the liabilities under their lease. And it's really important to have this kind of stuff in, because it retains flexibility for the tenant. But if that lease clause isn't drafted properly, it can represent risk for the landlord. And the landlord needs checks and balances to approve these assignments and sublettings, and usually would need to grant a license to do that at the tenant's cost. So again, you want the right to check covenant and make sure that it is the right covenant that is going to be coming in, that if they're equal to or better than the existing tenant, obviously that's going to be a good thing. User clauses, what are is the tenant actually able to use the property for? You want to make sure that this has got some form of planning alignment. So for example, don't just say to be used for the sale of widgets, because they probably wouldn't be able to dispose of it, and therefore they wouldn't be prepared to pay a higher rent for that. If you say for the sale of widgets or any other use within Class E of the Planning Use Classes Act, then that retains some flexibility. But again, the landlord has the right to grant a license for this user and make sure that that if there's any change of use that they authorize it. So wider user clauses can improve letting flexibility for tenants and for landlords. Restrictive clauses can definitely reduce demand. So it's not in your interest to restrict this clause. And again, when you're reading a lease, if you're buying a property, just check this out. Tenant covenant, we've talked about, is it independent? Is it national? Look at their accounts, do credit safe checks, look at trading performance, etc. Because in commercial property, you're underwriting the business, the tenant, as much as the building. So if there's an existing lease, you really want to get under the skin of that tenant, speak to them before you buy, make sure you absolutely understand their business and their credit worthiness as well. And that's the quality of the tenant covenant. So confusingly, we call it the tenant covenant, which is the quality of a tenant. But we also call the tenant's lease clauses tenant covenants, and the landlord's lease clauses landlord covenants. There's lots of other lease clauses in there, but if you're first just looking for a deal, looking at those kind of lease clauses, you want to understand those ones first of all. And I've done another episode on leases before where I go into a lot more lease clauses, but I think it's really important that you don't get overwhelmed by leases. So if you look at nothing else other than these, obviously look through the rest of the lease and just see if you can find any other important lease clauses, especially landlord's liabilities. So if the landlord's got a liability for running a service charge, or there's caps on service charges in the lease that the tenant has to pay, or if there's any other obligations, look at landlord's covenants to see what obligations they've got. A well-drafted lease won't put that many obligations on the landlord, and most of them will be on the tenant. So don't try and read a lease like a solicitor. Investors don't need to become lawyers, but you do need to understand how to read a lease, and practice makes perfect. So genuinely make sure you start reading these things. You need to know where the risks are, where the opportunities lie, and what questions to ask, really, really importantly, because sometimes it's just understanding the right questions to ask of your experts that you're dealing with, or whether that's agents or solicitors, that's the really important thing. So make sure that you have a great professional team to go to, agent, solicitor, asset managers, potentially managing agents. So you can ask these questions, but you want to be self-sufficient in this as well. Commercial leases aren't as scary as they first appear. Practice definitely makes perfect. The lease often drives more value than the building. Vacant commercial buildings are worth nowhere near as much very often as buildings where there's a decent lease on it. You want to focus on the fundamentals to begin with, and then go into a deeper dive, possibly with a solicitor or an agent at that point. You don't need to understand every legal word, and the more leases you read, the easier it becomes. And of course, one of the biggest shifts I see from investors moving from resi into commercial is the point at which the lease stops becoming intimidating and starts to look like an opportunity, because really that's when you're becoming a commercial investor. If you can really understand this stuff, if you can understand how leases work, you start seeing value where other people just don't. Whether that's short leases means you can add value, or longer leases means that you can, that actually you've got a more secure asset. And this is often where the best deals are found. So don't put this one on the too difficult pile. Dive in there head first. Bring in professionals to help you as and when you need them. Certainly, if there's anything kind of complicated or complex, you definitely want to bring a solicitor in at that point. But practice makes perfect on this stuff. So my challenge to you is to go out and read some commercial leases and see how you get on. Thanks for listening today, and I look forward to seeing you next time on the Commercial Property Podcast.